So you want to start investing or get a little bit more serious about investing in the stock market. Perfect. I think that is a great idea because it's one of the best ways for average people like us to make their first $1 million. But to improve your chances of becoming a successful investor, you're going to need to understand how the stock market actually works. You'd be surprised how many people nowadays start investing without knowing the basics, like what makes a stock price go up and down, then lose money, blame it on the stock market, and end up never investing ever again. I was one of those people when I first started investing. I didn't know anything, but I just started buying stocks because, hey, that's what everybody's doing. Then, of course, I ended up losing money because my lack of basic stock market knowledge. This video is going to cover all of the basic knowledge a stock market beginner would need to know to improve their chances of making money as opposed to losing money through investing. If you don't mind, please do me a huge favor and Hulk smash that thumbs up button. It helps support myself and my assistant. Her name is Molly. If anything is unclear and you have questions, then please leave them down in the comments below and I will answer every single one of them for you. Literally, every single one. I know it's going to be a lot, but challenge accepted. So what's even the point of investing money in the first place? The way that I look at it is that there's really only 3 things for you to do with the money that you earn from your job. Number 1, you can spend it to just buy things, which is pretty fun sometimes. Number 2, you can just let it sit around, maybe under a mattress, in your wallet, purse, or in a bank account. Or number 3, you can invest it through something like the stock market. In the end, the first 2 are gonna leave you with less overall money in your pocket. But the third one can take that money that you have right now and double, triple, or even possibly quadruple it over time. Think of investing through the stock market like creating a second source of income for yourself. Just like working your job where they pay you for the work that you put in, investing pays you through ways like increased values of the stocks that you own or through dividends that those stocks pay out. If you want to grow that $100 you have in your pocket or bank account to $200, then the stock market is where you can do that. But the stock market isn't necessarily a physical place that you go to buy and sell stocks. Yes, there are physical locations around the world where people buy and sell stocks, but for average people like us, we're doing this through the internet because it is so much easier. All the stock market is where shares of stock are bought and sold between people on a regular basis. You're not really investing in the stock market, you're investing through the stock market. Think of the stock market like a flea market. You're not buying things from the actual flea market, you're buying things from all of the different vendors who have tables set up at that flea market. It's just a place where those transactions of buying and selling happens. What you buy through the stock market is different investments, sometimes referred to as equities. Now, an equity is basically just the ownership of something. In this case, the equity that we're talking about specifically is stocks. A stock is just a piece of ownership in a publicly traded company. We're going to use Apple as our stock example for this whole video because it's probably the easiest for everyone to understand since we're all aware of most of the products and services that they sell. You can basically swap Apple out for any other publicly traded company, and this all applies to them as well. When you purchase any amount of Apple stock, then you actually own a piece of the company, which is commonly referred to as shares of stock. Now, no matter how big or small, you benefit from the success of that company for as long as you own the stock that you purchase. Publicly traded companies each have a limited amount of shares of stock available for you to purchase. Now, at this point, Apple has over 17 billion shares available to be bought and sold. Some of these shares are owned by individuals like you and me, some are owned by Apple employees, some are held by different index funds, mutual funds, and many other types of companies and institutions can own Apple stock as well. Nowadays, depending on the brokerage that you buy stocks through, you don't have to buy full shares of a stock. You're able to purchase fractional shares, which reduces the amount that you need to start investing. On the day that I took this screenshot, one share of Apple would cost you $128.70. Now, in the past, you only had the ability to purchase one share if you had that full price amount. If you didn't have at least the $128.70, then you'd have to wait until that price came down or you had more money to invest. But since we have access to fractional shares, you could use any amount of money to buy a fraction of the stock. So if you only had $64.35, then you could buy half a share of Apple stock because $128.70 per share divided by 2 is $64.35. Hashtag, wait for it, math. So we've covered what the stock market is and we've covered what a stock is. prices. So the next question should be, how do you actually buy and sell stocks? To be able to make trades in the stock market, you're going to need some assistance from a middleman to help you out with a transaction of buying, selling, and keeping track of those stocks that you currently own. These middle people are commonly known as investment brokers, online brokers, or sometimes brokerage firms. Some of the most common ones that you've probably heard of before are Vanguard, Fidelity, Charles Schwab, and TD Ameritrade. Then we have newer ones that are geared more towards younger generations like Robinhood, M1 Finance, which is my personal favorite, Webull, Acorns, Wealthfront, and Betterment. Whenever you want to buy a stock, there has to be someone on the other end who is willing to sell their stock to you for that price that you are asking. On the other hand, when you want to sell a stock, there has to be someone on the other end who is willing to buy it from you at the price that you want to sell it for. Instead of trying to get in touch with a random person in the world who wants to buy or sell that stock to you, these online brokers bring both parties together to complete that transaction. You pretty much just tell them what to do and they'll handle all of the busy work for you instantly. I did create a free online broker guide to help you figure out which one would be best for you. I'll tell you how to get that later in the video. But you can't just buy and sell a stock for whatever price that you want, because it's all based on the current price per share. Whenever the stock market is open, this price is constantly fluctuating up and down and literally changes by the second, but more about why it changes in just a minute. Back to the screenshot that I took of Apple stock. The price per share at that point in time was $128.70. Now, if you wanted to buy or sell Apple stock at that point in time, then that's the price that it would go for. If you wanted to say sell shares of Apple that you own for $200 per share at that point in time, then you could place that trade through your online broker, but there wouldn't be anyone out there willing to buy your stock for that particular price because it's higher than the current price per share. On the other hand, if you wanted to buy Apple stock for $50 per share, then you could technically place that trade with your online broker, but there's no way that they'd be able to find a seller for you, because there's no seller out there who is going to sell their Apple stock to you for less than the current price per share. If you have a target buy or sell price in mind for Apple stock, then you'd have to wait until the current price per share reaches that amount that you're looking for. And that brings us to the question of what in the world makes the price per share of a stock increase and decrease in value. This is sort of a loaded question because there's a ton of answers to that, so I'm going to touch on just a few of the more common ones. When it comes down to it, the ultimate answer to that question is that at a basic fundamental level, it's based on supply and demand in regards to the amount of shares that are available for that particular stock. In case you're not aware, supply and demand have an inverse relationship. When the supply of something increases, we'll usually see the price decrease. Because there's more of it, less people want to buy it, so the price has to decrease to get rid of it faster. And when the supply of something decreases, we'll usually see the price increase. Because there's less of it available, people are willing to pay more money for it. You could think of it as very scarce because there's less supply of it. The best example that I can give is with limited edition shoes like these Nike Mags, which were a replica of the shoe from, of course, Back to the Future 2, which is such a good movie. Everybody should check it out. In 2011, they only released 1,500 pairs. Now, because the supply was so limited, they sold for anywhere between $2,300 and $10,000 because the demand was so high. Supply is low and demand is high, which greatly increases the price. Now, I'm sure that they're going for a lot more than that on the secondary market at this point, but this is what happened when they originally released them. On the other hand, if Nike comes out with a shoe where they produce, say, 5 million pairs, then the price for a pair of those shoes are probably like $60 because there's a lot more supply than there is demand. So they have to keep the price low so that they can continue to sell that supply that they have. It's the same thing with the amount of shares available to be bought and sold for a particular stock. For Apple, they currently have about 17 billion shares out there that are owned by various people and being traded on a regular basis. When more people are trying to sell their shares of Apple, then that means that there's more supply out there and less demand, which will lower the price per share of their stock. It would be like saying of those 17 billion shares available, Group A is trying to sell 15 billion of their shares, while Group B only wants to buy 5 billion of them. When less people are trying to sell their shares of Apple, but demand increases because more people want to purchase the stock, that price per share will naturally increase. In this case, it would be like saying that of those 17 billion shares, Group A is only willing to sell 3 billion of the shares, but Group B wants to buy 15 billion shares that aren't actually available at this time. Now that you understand the supply and demand side of things, there are things that could happen that would make people want to buy and sell more or less less shares of Apple stock, which would mess with the supply and demand. Now, this is going to play into why you see the stock price increase or decrease every second when the stock market is open. We could go really deep with this because there's a ton of different factors, so I'm just going to touch on a few just to give you some basic understanding. The first thing that will change the direction of a stock price is good and bad news. When Apple announces the release of a new breakthrough product like the Apple Car, and investors view that as a way for the company to make more money, then we'll usually see an increase in the stock price if they really believe in that positive news. That's because investors would start to purchase more stock due to that good news and high future expectations. On the other hand, if later down the line that Apple Car turns out to have a bunch of issues, which means consumers would just stop buying them, then that could eat into the profits that investors were expecting, which would make some of those investors want to sell their shares of that stock. This is naturally going to lower the price per share by a lot within a short period of time, or it could decrease gradually over a longer period of time. The good news when it comes to a company like Apple and their price per share is that they make money in so many different ways through a ton of different products and services that even if one of them doesn't perform as expected, it's not going to tank the whole business. So if sales of iPads were lower than expected this year, then that might only make their stock price decrease by say 5%, because some of those losses were offset by the increase in, we'll say, MacBook Air sales. Now, if Apple only sold iPads and their sales were lower this year, then that stock price might decrease by, say, 20% because of it, and because they can't make up those sales and revenue from other products because they only have that one product. The price of a stock today is heavily determined by expected future returns. Think of stocks like very futuristic. They are always forward-looking. Sometimes we're talking about expected returns 6 months into the future, 1 year into the future, 5 years, or in some cases, we're talking about wild numbers like 20 or 30 years into the future. No names, please. Tesla. Excuse me, I had something in my throat. Once that pesky health crisis started to become more real and businesses were shutting down in late February of 2020, we saw the stock market tanking until about the end of March. Stock prices were dropping because there was a ton of uncertainty for how the future was going to play out. No one really knew how long this thing was going to last and how badly it would impact future business profits. This caused investors to start selling stock, which increased supply, decreased demand, and reduced the price per share of a ton of different stocks. Eventually, through better understanding of the sickness going around, some of the businesses opening back up, and government assistance, investors felt a lot more comfortable and positive about those future returns of all of these publicly traded stocks. I compare the stock market to an overly emotional 13-year-old. The stock market can handle good news because it knows what to do: go up. The stock market can handle bad news because it knows what to do: go down. But one thing that the stock market hates, they absolutely hate, is uncertainty, because it has no clue what to do. Now that you have an idea of how stock prices work, how do you actually make money investing in stocks? Now there's quite a few ways to do that, but there's really two main ways that most people make their money in the stock market. The first is through buying shares of a stock for one price and selling them for a higher price than you originally purchased it for. 5 years ago, one share of Apple stock cost around $24 per share. Now at the time that I took this screenshot, one share of Apple is worth around $128 per share. If you purchased that one share for $24 back then and sold it today for $128, then you would have made $104. The second way to make money in the stock market is through a dividend that a company pays out. All a dividend is a one-time payment from a company when you own their stock. Now, sometimes a company will pay these out once per year, twice per year, 3 times per year, and most commonly 4 times per year. As long as you own their stock by a particular date, it's different for every company, then they will pay you out that dividend, and that's how you make some money. Now, when a dividend is paid out, it's just deposited into your investment account for you to either withdraw into your bank account, or you can reinvest it back into the stock market. One thing to keep in mind is that not all companies pay out dividends if you own their stock, because it just depends on that particular company and what their policy is. But there are quite a few companies that do. Companies like Apple, Verizon, and Microsoft do pay a dividend, but companies like Tesla, Facebook, and Amazon do not. Another thing to know is that the dividend amount that you'll be paid will vary from company to company, so they're not all the same. Make sure to hit that thumbs up button before you go. In the description, I'll have a link to the free investing app guide to help you figure out where to invest your money. And there's also some info on how to earn one free stock worth up to $200 from Robinhood when you open an account through that link and deposit money within 30 days. Watch this Roth IRA video to your left next to learn about the account that you should be investing your money into first. I'll see you in the next one, friends. Done.